Credit cards, how they actually make money off you. You think credit cards give you rewards, cash back, points, free flights. But that's not the real business. Credit card companies make their money from interest, and they don't need you to be irresponsible. They just need you to carry a balance. Today, I'm breaking down exactly how this system works. APR, minimum payments, rewards, credit scores, and why small decisions quietly turn into long-term debt. Let's start simple. What a credit card really is. A credit card is a short-term loan. Every time you swipe it, the bank pays the merchant. You now owe the bank. If you pay the full statement balance before the due date, you usually avoid interest. If you don't, interest starts accumulating on the remaining balance. That's the entire model. APR, the cost of carrying a balance. APR stands for annual percentage rate. It's the interest rate applied to unpaid balances. If your APR is 20%, carrying debt for a year would cost roughly 20% extra. But interest doesn't wait a year. It compounds, often daily. That means interest is calculated on your balance every day and added continuously. The longer you carry debt, the more expensive it becomes, quietly. The minimum payment trap. Now let's talk about minimum payments. You owe $3,000. Your statement says the minimum is $75. That feels manageable, but most of that $75 goes toward interest. Only a small portion reduces the actual debt, so the balance barely changes. You keep paying, interest keeps accumulating, and the debt stretches across months, sometimes years. Minimum payments are designed to keep the account active, not to eliminate the balance quickly. How normal debt starts. Debt rarely begins with a crisis. It begins with convenience. You charge $3,000 for travel, gym equipment, or random purchases. You plan to pay it off soon, but something else comes up, another expense, another swipe. Now the balance grows, not dramatically, just gradually. That's how long-term credit card debt forms. How rewards are funded. Rewards are not free money. Credit card companies earn revenue from interest on carried balances, merchant fees every time you swipe. Businesses pay a small percentage of every card transaction. That helps fund cash back and points. But the largest profits typically come from interest. If you pay your balance in full every month, rewards can benefit you. If you carry a balance, interest usually outweighs the rewards. Credit scores and utilization. Your credit score reflects how risky you appear to lenders. One major factor is credit utilization, how much of your limit you're using. If your limit is $5,000 and your balance is $3,000, that's high utilization. High utilization can lower your score. Using credit responsibly improves your profile. Depending on it heavily can hurt it. The system rewards control. 0% APR offers. Promotional 0% APR offers can be useful, but only if the balance is paid off before the promotional period ends. If it isn't, the regular interest rate applies to the remaining balance, and those rates are often high. Promotions require planning. Without discipline, they simply delay interest. The psychology behind it. Credit cards reduce the emotional pain of spending. Tapping a card feels easier than handing over cash because payment is delayed. Research consistently shows people tend to spend more when using credit compared to cash. The reward happens now, the cost arrives later, and humans are wired to prioritize the present. That's why this system works. When credit cards are smart. Credit cards are tools. Used properly, they build credit history, offer fraud protection, provide limited rewards. Used improperly, they create interest costs, extend debt timelines, and increase financial stress. The card isn't the problem, behavior is. Credit cards are loans. APR is the interest rate. Interest compounds over time. Minimum payments slow debt reduction. Rewards are funded by fees and interest. Carrying balances makes rewards expensive. Utilization affects credit scores. Promotions require discipline. Spending feels easier on credit. Interest profits from delay. Credit cards are not scams, they are structured systems. If you pay your balance in full every month, they can work in your favor. If you carry balances, they work against you. The difference isn't the card, it's control. If this breakdown helped you understand credit cards more clearly, like the video. Comment below. Do you pay your balance in full each month? And subscribe if you want more precise, no-hype breakdowns of how financial systems actually work. Because understanding the system is how you stop paying for it. I'll see you in the next one.